Because the single most reason why I love SCHD is not because it has a super high dividend, but because that dividend continues to grow every single year and will continue to grow. So whatever you buy in at today means you won't just have a higher ETF price down the road, you'll also have a higher dividend than you paid for, and that's the true secret beauty behind this ETF. SCHD has been one of, if not the best dividend ETFs for passive income over the past decade or longer, but in the past couple years, SCHD has been underwhelming as far as price appreciation. Also, the economy has been struggling and will most likely continue to struggle over the next couple years. So what can we expect SCHD to do over the next 5 to 10 years? How about 20 years from now? Is this still the best dividend ETF for us to be investing in right now? In this video, I'm going to give you my thinking as far as where I believe SCHD will be by 2030 with a price prediction, and then also where the dividend will be as well. I'm going to give you a tool that I use to figure out future dividends and if buying a certain investment is worth it short term or long term. I'll also share some key metrics for you to look at yourself when doing your own research on what dividend ETF makes the most sense for your investing goals and to bring you to financial independence much quicker. I'll also explain how I'm investing right now in October of 2023 and how I'm going to be investing over the next 3 to 6 months, because I think it's going to get a little bit crazy out there. And so I'm going to give you a little bit of insight into what I'm personally doing. No matter if you want to invest in dividend ETFs or not, understanding what we're about to go through is going to be very important for investors anywhere. My name's Nolan Govea. My students at my university call me Professor G, and I made this channel to make investing simplified. Now, you probably already know that SCHD is the Schwab US Dividend Equity ETF, and it's a very strong dividend ETF. SCHD tracks a market cap weighted index of 100 dividend paying US stocks whose selection universe only includes firms with a 10-year history of paying dividends. This is one reason why I absolutely love SCHD, because it doesn't just have companies that are paying out a dividend, it has companies that have been paying out dividends consistently for over 10 years. This just makes it a very safe option. Within that universe, SCHD uses fundamental screens like cash flow to debt ratio, return on equity, dividend yield, and dividend growth rate to build its portfolio. The objective is to focus on quality companies with sustainable dividends. Individual securities are capped at 4% and sectors capped at 25% of the portfolio. A lot of people have problems with certain index funds or ETFs because they say they're not weighted very well, and maybe has too much of healthcare or too much technology or financial sector, and so it makes it unbalanced and you're getting too much of a certain thing, so that brings your risk super high. SCHD keeps risk low by making sure that they cap certain things. Its overall composition is reviewed annually, while the portfolio is rebalanced quarterly. SCHD consistently has between a 3.5 and 4% dividend, which is incredibly high for an ETF that also returns at such a high rate. Usually when a fund has a high dividend, its price appreciation doesn't really go up very much. But the total return of SCHD actually mirrors that of the total return of the S&P 500 on average over the past 10 years. But remember, SCHD is giving you cash flow of 3.8%, where the S&P 500 is only giving a dividend of 1.5%. So that's more than double. So what's going on with SCHD? Actually, what's going on with the market in general? Right now, we have high interest rates, high inflation, incredibly high debt overall as a country. There are wars and scary things happening around the world. Most are saying that we're headed for a recession in 2024, and so investors are getting quite worried. At the beginning of 2023, the failure of SVB caused a lot of fear in the market as people feared that other banks could fall, and some eventually did. SCHD had a large amount of financial institutions within the fund, as historically financials have been a pretty safe holding. SCHD also looks like it's doing worse than it actually is doing, because when you compare it to indexes like the S&P 500 or the NASDAQ 100 index, you can see that the types of companies that SCHD lacks is technology. Since tech companies are on an absolute tear this year in 2023, any funds that don't hold them are seemingly not doing great, which is why I advocate so much for my 3-fund portfolio. In this video here, I even explain how much of each fund to invest in based on your age, so I'll link to that below so you can watch later. But with that, you'll get the best of all worlds as far as tech, but then also the high dividends. Anyway, people are absolutely blowing it out of proportion, saying that SCHD is doing bad or terrible this year. Because if we actually look at it, yes, over the past 6 months, it's down 4.45%. But over the past year overall, it's actually up almost 2%. If this is a bad year, then I'm all for it because I gained 2% in that price appreciation, but I'm also gaining about 4% in that dividend. So really, on a bad year, I'm gaining 6% with this fund. And statistically, this is one of SCHD's worst years. Yeah, I'm definitely in for this. To figure out where I believe that SCHD will be as far as price prediction by 2030, and then also where I think that dividends going to be by that period, let's just use actual data that we have from the fund, and then also understanding the types of events that we have coming up and the economy and where it's at now compared to where it should be in about 7 years. In any type of investing, the most accepted formula for figuring out when your investment is likely to double is by using the rule of 72. And you can use this for any investment or ETF, but you want to make sure that when finding that average rate of return, that you're looking for a historical average rate of return of at least data from at least 10 years. If it's a fund that's only been around for 2 or 3 years, and one of those years it went up like 100%, it's really going to throw off your average and it's going to make it seem like you're going to get there a lot quicker. For SCHD, we have over 12 years. And as you see here, the average rate of return since its inception in 2011 is 12.5%. For all the naysayers and my favorite little negative commenters down in the comment section, I'll use the lower rate of return, which is the one of the past 10 years only, since it includes this year, which is one of its worst years. That rate is a little over 11%, so I'll just use 11% to make it easy. Now remember, this is the total return, which means that it's price appreciation, or how much the ETF goes up each year, plus how much the dividend returns. So since we're saying that the dividend returns about a 3.5% and the total is 11%, we take 11% minus 3.5% and that comes out to 7.5%. So that's the actual rate of return for just the price appreciation of the ETF. With the rule of 72, you take 72 and divide it by the return percentage, which in this case is 7.5. 72 divided by 7.5 equals 9.6. This is saying that based on this return, it'll take you about 9.5 years for the investment to double. But if you're reinvesting those dividends, which I hope that you are, we can use that full 11%. So 72 divided by 11 is 6.5 years, which means that it'll take 6.5 years to double your investment. SCHD's price today is $70.46, so based off of data from many years and using a widely accepted formula that finance professionals use daily to pick their investments and to forecast, we can pretty confidently say that SCHD is going to double in price by about 2032, because that's about 9 years away. So I expect by 2030, the price per share for that ETF to be around $115 to $120. And I invest like I expect that type of growth because SCHD is the second biggest holding in my entire portfolio, right after the S&P 500 or VU. Now let's get into an even more exciting number, the dividend. Because the single most reason why I love SCHD is not because it has a super high dividend, but because that dividend continues to grow every single year and will continue to grow. So whatever you buy in at today means you won't just have a higher ETF price down the road, you'll also have a higher dividend than you paid for, and that's the true secret beauty behind this ETF. Looking at the dividend growth over the last 10 years for SCHD, it's been phenomenal. When we actually look at the numbers, we care about something called CAGR or CAGR, which is the compound annual growth rate. This basically just states how much the dividend is growing each and every year. SCHD has increased its total annual payout for 11 years in a row. Not only that, but the payout has grown at an impressive 11.3% compound annual growth rate over that time frame. So using my favorite tool to figure out dividends in the future would be marketbeat.com, and it's the dividend calculator. So let's just say that you buy in today with one lump sum. You buy 1,000 shares of SCHD at today's price of $70.46. We'll stick with the lower end for the dividend yield and predict about 3.49%. The CAGR has been above 11, but let's just put 8% to be safe. The share price alone was 7.5%, and we want to see 10 years. And remember, we're not adding another dollar to this ever. Just the one-time lump sum. These numbers are insane. From that one lump sum in 10 years, the dividend payment would be about $7,132 per year. As long as you're reinvesting your dividends and the drip is turned on, each year SCHD will buy you new shares without you even having to add any more money. You will have started by investing that $70,000 and now your money grew to $192,000. The dividend is increased each year as well, and so if you don't need to pull the money at 10 years and just let it keep growing, at 20 years, now you'll have over $500,000 in SCHD, and your dividend is paying you almost $2,000 per month of passive income. Remember, all of this was if you just did one lump sum one time. So if you were able to put in a little extra, like $200, $500 extra dollars per month, all that whole time period, you would just be growing like crazy and you would hit that financial freedom even quicker. Also notice that even with their formulas, they're predicting an SCHD price close to that $120 range that I predicted in 2030 as well. So what am I doing with this data and with these numbers? I believe 100% in SCHD, and I think it's here to stay. It'll remain one of my top ETFs, but I also understand that over the next year to 2 years, we as a country are going to be going through a lot of financial issues, and we have to dig ourselves out of this big hole that we're kind of in. We may be entering a recession in the early parts of 2024, and people definitely need to be paying off their debts that they're starting to accumulate over this last couple years. That'll mean that there's less money to be buying things, which means that companies are going to profit a little bit less, which means that overall, stocks and ETFs will probably drop a bit or at least stay pretty stagnant. Knowing this only makes me want to accumulate more, because I know for a fact that over the next year, these are going to be the best prices that we see in great ETFs like SCHD or VU or even the technology ETFs, probably for the next decade. Because over the next year, in my opinion, this is going to be the bottom, and then from there we'll start a new bull market, and so the price is going to rise at that point. So I'll be buying more and more of SCHD every single month, and then the other 2 ETFs that I talk about in my 3 ETF portfolio. I go over that in this video here that I mentioned earlier in this video, where I talk about not only the 3 ETFs, but also how much of each one that you need to buy based on the age that you're at right now. Watch this video now, and if you've already seen that one, then watch this one.